Good afternoon, and welcome to the 2009 Tax Roundtable. I want to thank everybody for coming out here. My name is Mark Klemick. I'm the moderator of this discussion. I'm the head of the Federal Tax Practice Group here at McDonald Hopkins. To my right is Mike Riley, who is a member in the Estate Planning Department and also does a fair amount of executive compensation planning. Next to him is David Call, who is also a member in the Business Department and is the head of our Capital Markets Group. And finally on the end is Tom Zano, who is the chair of the State and Local Tax Practice Group and the head of the Columbus office. And this will be the group facilitating the discussion today. It was about a year ago that I think most of us were sitting at this same table discussing in a roundtable the fact that given the election of a new administration and a lot of legislation and so forth, as to the high level of uncertainty as to the tax situation for many businesses and taxpayers. And sitting here 1 year later, the only thing I'm more certain of is that it's a year later, and we may be 1 year closer to some significant tax changes, but I don't think the level of uncertainty has gone down by any means, and in fact has probably only increased. The theme of this roundtable will be really focusing on two things that we are pretty sure of despite all this uncertainty. The first being that tax rates are not going down anytime soon, and in fact are likely to go up significantly in the future and possibly the very near future. The other thing we know for sure is that the economy is still struggling, and because of that, typically businesses are experiencing lower profitability, valuations are down, and given those two knowns, what can we do at this point? How can we engage in some tax planning to, if not take advantage of those two factors, to at least try and mitigate the problem as best we can? So the first part of the discussion is going to focus on why do we think tax rates are going up in the near future, or at a minimum beginning in 2011. And David is going to talk about some legislation that's out there and President Obama's budget proposal. But the key here, and really a situation that I don't think we've ever experienced before, is even with no legislation, even with no action by the President or by Congress, tax rates are going up in 2011. And that's because the tax cuts that were enacted, they're referred to as the Bush tax cuts, enacted some time ago, those are set to expire beginning in 2011. So 2010 is the last year that we're going to have the 15% rate on capital gains, the 15% rate on dividends, and the highest marginal tax rate for individuals being 35%. Even if nothing happens, those rates all go up, in some cases significantly. The top marginal rate in 2011 will go up to 39.6. The capital gains rate will go from 15% to 20%, and most significantly, the dividends rate would go from 15% to the top marginal tax rate of 39.6%. So dividends especially are going to see a significant change in tax treatment in 2011. Now, this all depends on your tax bracket, obviously. For lower income taxpayers, the hit may not be quite as significant. I think Dave will mention part of the President's proposal would include maintaining some of those lower levels for married couples with taxable income of less than $250,000. But because of phase-outs of different exemptions and personal deductions and so forth, regardless of whether some of the President's proposals are enacted or whether the Bush tax cuts simply expire, it's very clear that tax rates are going up significantly. I mentioned the phase-out of the personal exemption and the itemized deductions. Those have been decreasing. The limitations have been decreasing every year through 2009, and in fact are set to expire in 2010. So for 2010, those limitations on standard deductions and so forth will not be in effect, but they come back in 2011 basically at 3 times their 2009 rate. And so in addition to the increases in tax rate, the reductions in the ability to use itemized deductions and personal exemptions will be back bigger than ever. And so between those two pieces, again, even if nothing else is done, tax rates are up significantly in 2011. Dave, what other legislation is pending out there, or what other indicators are there that rates are going to go up independently of the expiration of the Bush tax cuts?